Both NIFTY and Bank Nifty have just printed deeply bearish technical structures directly at critical support zones. The price has aggressively broken through multiple long-term support levels, shattering the foundation and signaling a complete structural failure across the board. On the macro timeframe, both indices have formed massive bearish Marubozu candles on the monthly charts. This chart compares historical monthly red candles by point drop. The current month's bar is the largest ever recorded for these indices in terms of sheer points. While retail traders are attempting to buy the dip, internal data and multi-time frame price action confirm a sustained liquidation phase. Relying on standard contrarian instincts is risky when macro structures are printing bearish extremes of this magnitude. To understand the immediate trap, we look at the weekly time frame and the price action leading into the expiry. By Thursday's close, the market created a false sense of security. Technicals temporarily painted what looked like a bullish engulfing or a dragonfly doji pattern. On Friday, a violent rejection completely reversed that setup. The green bullish hammer was engulfed and stretched downward to form a red gravestone doji and shooting star. This transition from an invalidated bullish setup into a validated bearish pattern increases the probability of further downside pressure. With the monthly and weekly timeframes now in alignment, the technical case for a reversal has substantially weakened. The put-call ratio, or PCR, is currently mathematically distorted, providing a misleading signal in this high volatility environment. A high PCR usually signals an oversold market ready to bounce, but this data is currently being skewed by specific positions. This 3D histogram shows a massive put concentration far from current price, at the 22,000 strike. These legacy quarterly positions inflate the aggregate PCR without providing structural support. Shifting focus to the 23,000 strike, active call writing forms heavy overhead resistance. This 23,000 call wall acts as a ceiling for the immediate expiry. Trading based on an aggregate PCR, without inspecting strike-level open interest, can trap buyers directly under this resistance. To see what is driving the market down, we pivot from options to participant futures positioning. Foreign institutional investors have added to their massive short positions, pairing that futures volume with heavy cash selling. Proprietary trading desks are aligned with these institutions, maintaining a bearish, heavily short stance. This institutional wall contrasts with retail positioning. Heavy downward flow from institutional desks is moving directly against smaller upward volume from retail clients. Retail clients are currently mega bullish, buying into this institutional selling pressure. When retail liquidity is the sole counterparty to aligned institutional shorts, the historical outcome is often a continuation of the downtrend. These technical breakdowns are being accelerated by external macroeconomic gravity. We are seeing compounding pressure from domestic currency levels and bond yields. The USD-INR exchange rate nears 95, while government yields rise towards 7%. This domestic pressure aligns with global liquidations in the S&P 500 and Bitcoin. These global economic factors are compounding. These headwinds weaken the case for a sudden V-shaped recovery in domestic equities. This raises the question, how do we identify a high-probability market bottom? The current market is in a steady, slow bleed. This behavior lacks the architecture required for a true reversal. This chart displays the anatomy of a capitulation, marked by a vertical drop and a sharp recovery. True historical bottoms, such as the March 2020 crash, typically require a panic-driven 3 to 4% gap down. Capitulation must also be met with aggressive, immediate institutional buying. We see another example of this signature during political events. During the general election, the market experienced a massive single-day drop, followed by immediate recovery. The current multi-week downtrend entirely lacks this panic and buying signature. Without a capitulation event, the slow bleed is likely to continue. This dictates a specific trading posture moving forward. It is rarely profitable to trade against the tick when institutional flow is aligned against you. If the 22,500 level breaks, the next logical support zone is 21,800. 21,800 has historically acted as an interim bottom where significant buying emerged in the past. At this stage, capital preservation is the priority. Hold short positions or keep capital in cash until a clean daily reversal signal appears. Until the market provides a structural capitulation signature, patience is the only viable strategy. Subscribe to the Insight Engine for continued technical updates.